Okay. Okay. Awesome stuff, right? I just trying to sort a couple of stuff out, right? Anyway, back to another session. To of this time. Make sure. Oh, the doors are not closed. Hey guys, back to another session, exclusive webinar session by Everest Fortune Group for Vantage Markets. Today we're gonna teach we're gonna learn about trade management, right? Anatomy of a trade, stuff like take profit placement, stop loss placement, entry placement. You know, sometimes when you get stopped out, of the trade, you feel like the market might have just spiked down, stop you out, and then go in the head up towards your take profit, or in cases where you have a take profit level there and the market just reverses right before it hits your take profit, right? So there are many times we're left wondering whether why does this happen. Why does the market tend to reverse right before a key level, right? Right before why does it seem to stop us out and then head in our original direction, or hit our profit, miss our profit by a bit, and then go against us, right? So there's actually a psychology behind that. And in today's session, which will be covered by Cassandra later, we'll be looking a little bit about that, right? You'll say, nice to see you, good morning. All right, nice to see you here again. And nice to see you here again, all right? But yeah, guys, we are trying out this new live stream approach, right? So we're live streaming across, I think it's Facebook, YouTube, and Telegram, right? Telegram, I'm not sure if it's working fully well yet, but yeah, we have a place where I can see all your comments. So anytime you have any comments or questions, feel free to send it through. I'll do my best to get to them, right? Cassandra will be doing her best to get to them too. All right. So anyway, today's session will be right. It will be run by us, Everest Fortune Group, right? So our best. I can rejig the slides a little bit, right? But we are award-winning research firm. Best FX and best FX research finalist 2019, 2020. 2020 and 2021, and best equity research for 2020 and 2021, right? So we usually work with major financial institutions and corporations, to kind of forecast where the markets are heading for them, but with a special partnership with Vantage Markets, where we're bringing you guys good stuff, the juicy stuff, the stuff that will take your trading to the next level. All right. So anyway, this will be the team that will be taking care of you, at least for the Vantage webinars, right? That's me, right? Desmond Leong, right? Later, the person who will be taking care of, who'll be the person who will be conducting the rest of the webinar will be Cassandra, right? She's a market strategist here, a really good trader, right? I think she passed FTMO about 2 times or 3 times in a row, right? Manages more than 300K of own personal funds, right? Really a good trader. So try to learn as much from her as possible. Trading style pretty similar, just that she uses a little bit more of the Ichimoku, right? And then we have Angelina, who you saw yesterday doing the market rep. Okay, yeah, but she won't be joining us today in today's session. Okay. Anyway, before we begin, a key thing that I always want to cover with you guys, disclaimer, is that remember, everything in this webinar is educational in nature. So nothing in this webinar should be construed as investment or trading advice. Do your own little due diligence before you guys trade. Okay. Right, yeah. So trading CFDs is dangerous, So yeah, exercise a little bit of caution, due diligence. Do your own due diligence before you guys trade. Now, I'll be touching really quickly on the agenda before I hand it over to Cassandra, right? So the agenda for today, the first thing we're going to look at, right, is the anatomy of a trade. So most people think that when it comes to trading, you're just looking at entry, stop loss, take profit, right? Most people actually just look at entry, right? And then they, you spend so much time looking for the ideal entry, and then the stop loss and take profit is just like an afterthought, right? But what we're going to do today, right, is that I'm going to show you the entire anatomy of a trade. Maybe in the basic one, we're going to talk more about stop loss and take profit placement, but we're going to show you that there's an equal amount of effort needs to be put to your entry and to your stop loss and to your take profit. And when we go more advanced, to your break even, to your idea and validation, to a lot more stuff. It's a lot more things needs to be put in place to help you to make a trade profitable, right? Don't just look at the entry, right? So in part 2, we talk about the ideal stop loss placement. We also look at try to debunk the popular myths, right? When you're on baby pips sometimes, right? And then you nothing against them, but you're on baby pips, and this you're reading this forum, and they're saying that, oh, when you see this trading signal, right, put a stop loss of 100 pips, put a take profit of 100 pips, and let it play out, right? There is a problem with that, right? Because using a fixed stop loss and a fixed take profit, right, sets you up for failure, right? You need to see what the market is telling you and then kind of fine tune it from there. So we'll be looking at a little bit about it later. Okay. Then after that, we will look at risk and lot size relationship. So a lot of people think that, when it comes to taking a trade, it's either binary, you take the trade or you don't take the trade. But we will look a little bit more into exactly how you take the trade. We have more confidence in a trade, you allocate more to a setup, right? Then we look at the ideal lot size when it comes into taking a trade. And of course, we'll kind of round it off by, what's the ideal risk percentage that you should set per trade. Okay. Now I'm going to pass the time on to Cassandra in a bit, right? Just let me go get her. Just give me a second, guys. All right. Anyway, sorry, I think I've explained everything there is with the agenda already. I'm going to pass the time on to Cassandra, right? And she'll be going through with you the rest of the slides. All right. Okay. On to you guys.
Okay. Hey everyone. Hey. Welcome to our webinar. Hey Jose. Hey, morning. Hey. Okay. I'm guessing Des did the introduction. I'm just gonna go on with the slides. So agenda for today is anatomy of a will be risk and trade management. So we're gonna go straight with anatomy of a trade. Give me a sec. Okay, so anatomy of a trade actually consists of, hey Robbie, Robbie. Oh, actually, I just want to find out from you guys how long you guys have been trading for, or like how experienced are you guys with trading, and if this is like, I just want to know what your experience is in trading. Good to see you, Harena. Oh, hey Harena, good to see you again. I see you have a different name here. Okay. Hello. All right. Okay. For those who are a bit more experienced in this, this may come off a bit too basic for you, but yeah, this is a good refresher. So, again, I was saying, and then anatomy of a trade consists of the entry, the stop loss, the take profit, break even, partial profit, and trailing stop loss. But for our webinar for today, we're just gonna focus on entry, stop loss, and take profit. Okay. So let's start with the stop loss. Stop loss placement. So there's there's actually a way to put your stop loss. The way that we use to put our stop loss that we think is more effective, or it's more effective when avoiding trying to get wicked out prematurely, is to put the stop loss above your key level. So it's either above or below the key levels. Okay. Hi MKO, welcome to the webinar. Hey. Okay, yeah. So we always look for the key levels first. When I say key levels, I always mean like support and resistance, or like any levels with like Fibonacci confluence, or like any very significant level. That's what I mean by key levels. So whenever we find a key level, we usually place our stop loss and take profit before or after the key level. So I'll give you guys an example. So this is a major resistance area right here. What we usually do is we put it above like let's say it's a resistance, we will put the stop loss above the resistance. And the reason we do this is to avoid getting wicked out or like stopped out prematurely. So price tends to do a lot of wicking sometimes. Actually, it depends on the charts you're looking at, but for gold especially, it does a lot of wicking. Okay, so when you put your placement, your stop loss placement a bit higher from the key resistance, if you are correct, again, if you are correct, you're gonna not get stopped out prematurely if you're correct, right? So price will just go there, kind of like test that area a bit, and then kind of turn back. What kind of like what this example is doing. So similarly with your take profit, what you want to do is price is very attracted to key levels. Key levels meaning support and resistance. So price tends to want to go to these key levels. You can see how price moved down here. And what you want to do is put your take profit just slightly above those key levels. And the reason you're doing that is because, again, because price is attracted to those key levels, it wants to aim to go to the key levels where the yellow or this gold color is. So these gold colors are the key level. And then when price is on its way to the key level, what you want to do is take your profit all the way. So you don't want to put your take profit at the key level itself, just in case price just kind of like merely touches it, and then it misses your take profit. Because there are times where like there's spreads and whatnot, you might end up not touching your take profit. Like price may not touch your take profit and may just turn back from there. Okay, so that's how we put our stop loss placement. So this is another example. We can use this as a nice support level here. Okay, we buy thinking that price would go all the way up, right? We buy here. Okay, so a lot of not a lot of people, but there are traders, especially traders who are a bit newer to the game. They like to, they're a bit more, I think, misinformed. There's kind of this practice out there where people use like a fixed stop loss. So we don't use a fixed stop loss because a fixed stop loss oftentimes will get you wicked out prematurely. Okay, so a fixed stop loss is when, like, this is your entry, this blue line is your entry. People will count 100 pips from there, for example. It can be anything. It can be 50 pips, 30 pips, 200 pips. So that particular trader will be like, oh, today I only want to lose. I'm only willing to lose. So I'm willing to risk 100 pips. So they put their stop loss, which is 100 pips. They put it 100 pips from the entry, and it ends up just above the nice support level that we have here, right? It ends up above the key levels that we have. And that's totally against what we just said earlier on in the earlier slides, where we said to put your stop loss below your support or above your resistance, right? That's where you should be placing your stop loss. Below the support or above the resistance. So when you use a fixed stop loss, it oftentimes or sometimes it ends up not below those levels or above those levels, and you have it placed here. I mean, it's fine if you end up correct, right? It's fine if, like, from this second part, this blue part, it just flies up from here. But there are times where price is very volatile. I mean, a lot of times price doesn't do what you want it to do. Like, in an ideal world, obviously, I would prefer if price just shoots up from here. But there are times that price just comes down, kind of like move sideways a little, do whatever it wants to do before it actually ends up going to your take profit. So you don't want to get stopped out prematurely when price is doing that. Okay, so we can see from here, price didn't actually end up going up. Price came down first. It came down, it hit your stop loss. Okay, it hit your stop loss. And then it just continues. Like I said, if you put your stop loss like below the support, it wouldn't have hit your stop loss. But in this case, it did, because this trader, or this particular example, the trader was using a fixed stop loss where the trader was using 100 pips. Okay, but if you were using the other strategy where you put the stop loss above or below those key levels, then you would have missed it. Price would have continued up. And then there was a possibility that price either goes back to your entry and you can get out at break even meaning that you can get out without losing a single cent, or maybe you end up being correct, like it just shoots up from here. I mean, that is unlikely, but at least when it goes back to your entry, you can get out for the break even, right? You can get out for the break even and you don't lose this entire trade. So that is the importance of stop loss placement. Okay, so let's move on to take profit placement. We kind of touched a little on it a while ago. So this again is a clear and strong resistance area. Price has reacted off it twice. You can see one time, two times. Imagine if you have a strategy that requires a fixed stop loss. So again, using back the same example where traders use fixed stop loss, let's say your entry was right here. So you got in here at this blue dotted line. You got in here, and for a fixed stop loss of 100 pips, like you wanted to make 100 pips. So you put your 100 pips, 100 pips ends up being above the resistance area. So it ends up being up here, the resistance area. Price moves. It goes all the way up. It kind of barely touches the resistance and it turns back. So the lesson here is not to put your take profit blindly. It should always be below the resistance and above the support. So it is totally different or opposite from your take profit. Sorry, your stop loss placement. Your stop loss placement should be, the stop loss should be above the resistance, whereas the take profit should be below the resistance. Okay, and your stop loss should be below the support and it should be above the take profit. Okay, is everyone good with that? Is everyone clear with the placement of the stop loss and the take profit? Oh, good. Okay. So yeah, price went up. It kind of missed a little because although we do forecast price coming back to our resistance area, we just have to remember that price is attracted to those areas. It's just attracted, so it doesn't necessarily, it won't always like go up and touch the entire area. Sometimes it's just attracted to it, so it's just like, it's kind of like a magnet. So like it goes up, it moves up close to that resistance area and it kind of just reverses. So that is such a shame if you did put your take profit above that resistance area instead of below, because if you put it in the below, it's easier for price to hit your take profit. Okay, so risk and lot size relationship. I just want to find out from you guys, what do you think is the ideal percentage per trade you should be taking? Is it A, 1 to 3%, 5%, or 10%? Can you guys let me know in the chat box so I know what kind of risks you guys are usually taking for your own trades? Jose, Herena? Okay, we've got some answers coming in. Jose, Martha, Jose, they all got the same answer. Chan, Sarah has the same answer as well. Okay. You guys are very disciplined traders. Very, very disciplined traders. Okay. Okay, I was actually expecting different answers from you guys, but I guess everyone here is very disciplined and everyone used 1 to 3%, which is not correct or wrong. I just think it is the better strategy to use. So there are traders out there who use like 5% or 10%. I'm not saying they're wrong. I'm just saying to be safer, the rule that we practice and like I encourage people to practice is to use 1 to 3%, right? 1 to 3%, I think ideally is the best risk percentage to take per trade. Because I mean, if you think about it, let's say you're taking 1% per trade. That means that you have 100,000 account. Oh, okay, even Stanley is going for 1 to 3%. You have 100,000 account. If you're risking 1%, that means you're only risking $1,000 per trade, right? That means if price were to go to your stop loss, you will only lose $1,000 of your 100,000. That also means that you have to get 100 trade wrong before you can lose your account, which is like, I mean, even if you were just guessing, you probably won't be able to get 100 times wrong in a row, or like 100 times wrong, right? I mean, even if you're a horrible trader, it's probably like 70 to 30 or something, but not 100. So by using proper risk management, it's actually a way to like kind of safeguard your account so that you don't lose your entire account, so that you don't get margin call, so you don't like you I mean, come on, I'm sure everyone here has heard stories of someone losing heaps in trading. Like they had to sell their house, they had to sell their car because they lost so much in trading. They lost so much. But I just have to say that if you do use proper risk management, there is no way, or rather, the chances of you going bust if you're using the correct risk management is very, very low. Okay. So if you are just using 1% all times, or like 3% if you're being like very ambitious, it will take you quite a while for your account to go zero. So that's my recommendation, is to just stay safe and trade smaller. And I know there are traders out there who think that, oh, okay, I know there's this saying out there that there's a like high risk, high reward kind of mentality. I just have to say, if you are using the correct risk to reward ratio as well, there is no such thing as like a high risk, high reward kind of mentality. So I'll give you an example. You can actually go 1% per trade and make 10% that same trade, because you can always look for trades that are like very low risk and very high reward trades. So these are trades where like your entries right here, right? For example, your entries just right here, like where this black line is, the start of these boxes, and your profit is here at the bottom of this black box, right? So you're going to play this entire move, but your stop loss is just right here, right? So if it hits your stop loss, you only lose 1%. But let's say if it hits your take profit, you end up, hey Andres, welcome to our webinar, you end up making 10%. So like, don't listen to people who says that high risk, high reward, if I want to make it big in trading, I have to risk a lot. That is not true. That is so not true. You can risk very little and still be able to make a lot. Like I've done it a few times, and I think it's possible. It's possible. Like I've done it a few times. It just means that if I've managed to do it a few times, it just means that it's duplicable and it can be repeated. It wasn't a fluke, it wasn't an accident. It is something that can be done on a consistent basis, which is the most important thing we want to do in trading, to be consistent, right? Okay, so next question I have for you guys. I'm sure everyone knows this game. It's roulette, right? So you have one chance. You're in the casino. No worries, NTM. No worries. Okay, so you're in a casino. You have one chance. You only have one chance to play one round of roulette, right? I'll give you $100. I'll give you $100. Let's say if you bet on the red ball, you have a 48% chance of winning. You bet on the black ball, you bet on the ball landing on red or black, you have a 48% chance of winning. Okay, on either one, red or black. And if you pick the green, I think it's 4%, something like that, 2 to 4%. Okay, so my question to you is, right now you're either gonna bet the red or the black. What risk percentage are you gonna go for this trade? Sorry, for this game. Like, how much are you going to risk from your $100 to, like, let's say, for example, hope that the ball lands on black or red? Anyone? No one plays roulette here. Okay, we've got answers coming in. Jose says 50%. That means you will risk half. Marta is saying 25. NTM is saying 50%. Okay. We've got different answers coming in. 48, Stanley. Okay. So because your chances are about 48% to get it right, if you play the black or the red, I see a lot of you will go at least half, right? A lot of you will go at least half. Okay. I'll change the scenario a little. Okay. Now we're changing most of the red to black. Now you have 32 black, 4 red, and 1 green. You only have one chance, okay? You have $100, the same as the first time. Okay. Hamado is saying 10. That's really very risk adverse, Hamado. So you have 32 black now. You have 4 red and 1 green. Okay. I think the chances for you hitting black will be like 80+%. My question now is, how much would you bet now comparing to the first time with the $100? With the same $100, now how much would you bet? You're betting that the ball lands on one of the blacks. How much would you bet now? Can you guys let me know in the chat box? I want to know what your risk appetite is. Okay. I see. Everyone is now everyone's just like 75, 90, 80, 85. Wow. Okay. It's really different from the first time, right? Because the first time when I asked you guys were like 50, 25, 48, 10, 50. Now the answers are really different. Now it's like 85, 75, 90, 80. Like obviously your risk appetite would have increased because you know that your chances of winning is higher now. So like the whole point of this example was just to tell you guys that in trading it is the same. It is the same in trading. Whereas like if you see a trade, okay, you see a trade and all the stars align, it gives you confidence that there's a higher chance of you winning the trade, right? So similarly with this second example of roulette, it kind of gives you a feeling of like confidence that you will win this trade because like everything is aligning, the trend line is aligning, the support resistance is lining. Let me think. Ichimoku is lining up. The Fibonacci levels are lining up. This Fibonacci confluence. There's just so many things lining up in the same area. It gives you so much confidence that this trade, there's an 80% or a 90% chance that this trade will win. So when you see such a trade, my advice to you is that you can go much bigger. Similarly with this roulette example, you can go bigger because you know that you have a higher chance of winning. But without ignoring the first rule, the first rule is that you should go 1 to 3%, right? Remember, we are only going 1 to 3% on all trades. So if we were to use the first example, like let's say you see a trade that's good, but it's you don't feel very confident about it. You feel like, okay, there's a chance, like I feel like there's a chance that it might go to my take profit. There's a chance that it's going up. There's a chance that it's gonna go up. So when you see this kind of trades where it kind of gives you a signal that it's going up, but at the same time you're not too confident, my advice to you is that you don't have to totally ignore the trade. You can if you want to. You can if you just totally feel bad about it. But when you're a bit more unsure about the trade, my advice to you is that you can do 1%. You can do 1%, maybe even 0.5%, maybe 1.5%. So my point is that you can go lower for those trades where you're not as confident. And for those trades where it looks like this and you're aiming for the ball to land on the black, and for those trades where it feels like and it looks like everything's aligned and there's such a high chance of you winning, everything is aligned, even fundamental is saying aligned. If you go type in the news and it says that USD JPY is definitely going to shoot up to the moon, and on top of that technical analysis is saying that it's going to shoot up to the moon, every indicator that you pull out says that it's going to shoot up. Like for such instances, or when you see trades like that, you can go much higher. You can go 3%, right? You might even want to go, I don't know, maybe 3.5%, but it's best, sorry. it's obviously best to just stick with the 1 to 3%. It's best to stick with the 1 to 3%. So when you see trades, like beautiful setups like that, just, you can go higher, you can go 3%, but never, like, just don't over leverage, don't do half. Some of your answers are really scary, like you've got 90, 80%, 75. But yes, I know the example was different because I did say you only had one chance in roulette. But with trading, you don't only have one chance, you have multiple chances. If you get this wrong, don't worry, you can enter the next trade, you can look for the next trade, you can sharpen your skills, you can read trading books, you can watch YouTube videos, you can watch more webinars, and then get better at trading, and then go for your next trade. So it's not like that example in roulette where you only have one chance, right? Okay, so I hope we're good with risk management. Guys, in trading, please never use more than 3%. Okay, 90%. I see someone saying 90%. That's just not in trading. Okay, in the casino maybe, but not in trading. Okay, so the ideal lot size, what do you guys think the ideal lot size should be? I'm just gonna leave this here before I move on to the next slide, so I kind of know what you guys have in mind with lot sizes. Can you guys just let me know in the chat box, what do you think the ideal lot size should be per trade? I actually don't know if this thing is like a little laggy or what. Because like when I ask you guys questions, I realize you guys do answer, but there is a pause in between. Like I realize there's kind of like a time, like a 1 minute before I see your answers coming in. Okay. Andres is saying it depends. That is a good answer. That's a good answer, Andres. Hamado is saying 0.1. Okay. I think the correct answer here is Andres's answer, which is it depends. Okay, so it does depend. It depends on your account size. So the ideal lot size is actually linked back to our first question, which is the ideal risk that you should take, right? So I'll give you an example. You have 100,000 account. Let me go to the next slide. Okay, you have the example here says 50, so let's just use this example. Okay, you have a $50,000 account. If you're risking 1% on a $50,000 account, that's only $500, right? If you're risking 2%, that's only $1,000, and if you're risking 3%, that's $1,500, right? So there is a pause of some seconds, then people think another pause to answer. Okay. I can see why there's kind of like a lag in between, because every time I ask you guys a question, there's like kind of a lag, and then I see all the answers coming in. Like, I don't know if you guys are answering all at the same time or what, but like, yeah, I think there's possibly probably a 20 seconds or 30 seconds lag from the time that I ask the questions and from the time that it reaches you guys. Okay, so NTM is saying 0.1 on a 1,000 account. That's, I guess it depends as well. It depends on your lot size. So I'll give you an example why I say that it depends, because it depends on, first, your account size. You need to establish what your account size is. Secondly, you need to establish how much you are going to risk that trade, right? So it goes back to how much you think you should be risking per trade. So let's just use back the casino example where you have $100, right? If you're only risking 1% of $100, that's only $1. If you're risking 2%, it's only $2, and 3% is $3. So before you even enter the trade, you need to already ask yourself, and you need to already know how much you are risking per trade. So you go in $100, you see this trade, and then you're just like, okay, how much am I willing to lose this trade? If I get this wrong, how much am I willing to lose? That's the question you should always ask yourself. It should never be, how much do I aim to win? Okay, it should always be, how much am I willing to lose? You need to establish how much you're going to lose first before you establish how much you're going to win. Okay, because establishing how much you're going to lose first, it actually establishes how much your lot size is going to be. Okay, so let's say, for example, we have decided that we're going to take 1% for this trade. Remember, we're only doing 1 to 3%, depending on how confident we are on that trade. If you're super confident, go 3%. Like not so, go 2%. If you're not confident, your confidence is really low, go 1%, right? But you need to decide from the get-go how much you think you're going to risk. Okay, so let's say we've decided that we're going to risk 1%. That means we're only willing to lose $500 with this trade with a $50,000 account. Okay, so now what we're going to do, oh, sorry, I moved the mouse. Okay, no, so now what we're going to do is we're going to find our entry. You're going to look for your entry first, and then you're going to look for your stop loss, and then you're going to look for your take profit. Okay, for this case, when you're looking for your lot size, your take profit is not important yet. Okay, the more important thing is your sell, your entry, and your stop loss. Okay, so your entry is here and your stop loss is here. You now need to know the amount of pips in between the sell entry to the stop loss. So you need to know, if I get in here at 0.65444, if it hits my stop loss at 0.65963, how many pips did I lose? Okay. How I calculate is, because sometimes you're trading on your phone and you're not always in front of the computer and you don't have all those tools to help you calculate. So when I'm trading on my phone and I don't have all those tools to help me calculate, like let's say I'm outside at a cafe or like I'm having dinner and I really need to take a trade, although I don't recommend you taking a trade during dinner. Okay, what I do is I take this number, my entry number, and I minus, like I take the bigger number. I take the bigger number and I deduct the smaller number. So if we're taking 65963, we deduct 0.65444, you will have about 519, right? 519. So the difference from here to here is 519 pips or pipettes or whatever it is. Okay, so you now need to know 590. You need to know yourself how your account works and how your account works on your lot size, because different brokers or different platforms have different way of calculating. Okay, so I have found, because I used to have different accounts, 0.1 on one broker doesn't necessarily mean 0.1 on a different broker. So you need to know on your broker how much 0.1 or how much whatever is. You need to find out on yourself. If you need to use a demo account to figure it out, then yes, use a demo account. Okay, but I recommend that because this is a very important step. You don't want to accidentally key in more than what you should be risking, or worse, if you have a really good trade and you end up risking less than what you're supposed to be risking, you're actually not doing yourself a favor, right? Okay, so there's a difference of 519, if my math isn't failing me. There's a difference of 519. So let's say you're going at 0.1 lot. Okay, let's say you're going at 0.1 lot or 1 lot. That means for every point or every pip that it moves, you lose $1. Okay, so because you are only allowed to lose 500, because you have decided from the beginning that you're only allowed to lose 500, this is where discipline comes in. Okay, you are only allowed to lose 500. You take 500 divided from the pips here, and then you will get your lot size. Okay, I'm sure there are actually tools out there. You can just type pips lot size calculator in Google and something will come out. Okay, you can use that and you can calculate your lot size. Okay, so your lot size again depends on how much you're willing to lose. You gotta drill that in your mind. It's not how much you're willing to win. Okay, this is a very amateur mistake. I've done it before. Everyone who is new to trading that I know has done it before. If you have not done it, kudos. You're doing great because you are very disciplined. But like, even for myself, as a new trader, my lot size used to depend on my take profit. So I'll give you an example. I remember going into a trade and saying to myself, okay, today I want to make $1,000. So I want to make $1,000. I'm gonna get in here at this entry here, this blue line, and I'm gonna get out here at this green line. So what is a lot size do I need to go to make $1,000 if I get in? I've done it. Exactly. Everyone has done it. So if you've done it, don't worry. Even I have done it. It does take time to get this very bad habit out of your system. I must admit, it took me a while as well. But once you get it out of the system, once you finally decide to get rid of all those bad habits that has been stopping you from growing your account, you will see your account grow very fast. Okay? Once you're disciplined and you follow a system and you get rid of all these silly bad habits, you will see your account go from like $1,000 to $10,000, for example, $10,000 to $100,000. You will see your account double. But first, you need to get rid of these habits. Okay, so like I was saying, back then I would say to myself, oh, I want to make $1,000 today, and then I will adjust my lot size to like crazy lot sizes, like crazy amounts, just so I can reach that $1,000. But a lot of times sometimes it ends up hitting my stop loss, and I end up losing crazy amount as well. So please don't do that. Please learn from my mistake and all the new traders out there's mistake. Okay. This is another example. It's just trying to emphasize that even if your take profit is 90 pips, you shouldn't be using your take profit. You should still be using your 50 pips stop loss. Okay. It should always be your stop loss that decides how much your lot size is. It should never be a take profit. Okay. How much risk the lot size you trade. Yeah. Okay. This is actually a test, but I'm sure you guys would already know how to answer it because I think I did a good job emphasizing. Okay. Let's say I want to lose I'm only willing to lose $500 per trade, which is 1% of my account size. Do I take the 500 and I divide it by the 90 pips or the 50 pips? Can you guys let me know in the chat box? Please be able to answer this. If you guys don't answer this correctly, it means I didn't do a good job explaining it in the last slide. If I'm only willing to lose 1%, do I take the amount I'm willing to lose and divide it by the 50 pips or the 90 pips? Okay, thank you, Simone. Thank you. I'm glad no one answered 90 pips because I would be very, very scared if someone said 90 pips. Okay, that's great that you guys got it. Thank you, Sarah. I'm glad you guys got it. Okay, next, same thing. If I'm only willing to lose 1%, should you, in your equation, when you're calculating your lot size, should you be including the 20 pips or the 36 pips in the equation to calculate your lot size? So should you even consider the 36 or should you consider the 20 pips? Okay, thank you. Thank you, Sarah. Thank you, Simone. Oh my gosh. I am glad you guys got this. Okay. Okay, that's the end of our webinar. Right now, what we're going to do is, because we still have 15 minutes, we're going to move on straight to the live charts. Okay, we're going to move on straight to the live charts so that we can kind of try to apply what we learn. Okay, just give me a sec. Let me turn on trading view. Please excuse my charts. Someone was drawing on this. Okay. Can everyone see my charts? Okay, thank you, Stanley. I swear this thing, there's like a 30 seconds lag because all your answers are coming in at like different, at the same time, but just a bit later than when I ask the questions. Okay, everyone can see my charts, right? I just need a double confirmation because I don't want to be... Okay, got it. Everyone can see my charts. Thank you, Simon. Simone, sorry. I actually don't know if I'm pronouncing your name right. Is it Simone? Or Simon? It's probably Simone, right? Because there's an E behind. Okay, So before I move on to analyzing charts, I do want to find out from you guys if there is a particular chart or there's a particular instrument that you want me to look at. If there is, you guys can just let me know in the chat box and then we can kind of look at it and analyze it together. Okay. If you guys have, let me know. If not, I'm just gonna randomly see something. Nope, no one has any requests at all. Okay, you guys usually have requests. Okay, before I came in for the webinar, why I was slightly late and Des had to go out and get me is because I was looking for setups for you guys, right? Because the setup that I had for you guys earlier on actually already played out. So that's the thing about the markets, right? The market doesn't wait for anyone. It doesn't care if I have a webinar at like 5 p.m. Singapore time. It doesn't care. If it wants to play out, it's gonna play out. So I actually had a trade earlier on and it already reached the take profit. So I'm sorry I couldn't share that with you guys. I was trying to look for a different setup for you guys, but I couldn't manage to find one. So if you guys have any requests, we can try to look for one. Monday, like on Monday, I see. Oh, Simon. Like Monica and Simon. So Simon. Okay. Let's just highlight this first. I do see a channel, right? I do see a channel. So let's just highlight some of the things I see with this first. I do see a channel. We'll adjust that in a bit. Oh, okay. So if we do use a channel, it actually looks like it's a channel breakout already. It actually looks like there was a channel breakout. Or is it? Let's just adjust everything a little bit so that we can... Guys, I just want to let you know when you're using channel or trend line, it should always just be a guiding tool. It shouldn't be the tool that helps you make your decision, right? It should just be a guiding tool. So this is very subjective. Like some traders will look at this and be like, oh, okay, it might still be in the channel, right? Some traders will be like, no, that's a breakout already. So because channels and trend lines are very subjective, you should only use it as a principle of where you think the trend is. So I use this as a trend. So when I see this ascending channel or ascending trend line, I'm just gonna think, okay, price is moving in an uptrend. Okay. This is very subjective. This could be a breakout, could not be a breakout. It really depends on the trader's point of view. From my point of view, it is a fake out. A fake out meaning that it looks like a breakout, but it's not really a breakout. But then again, I say that's totally depending on the trader. So we're not going to look at this because this is unclear. So the beauty about trading is that, especially with Forex, that there is so many pairs. Look at this. There are so many pairs for you to look at. If you see a chart that is super unclear, what do? Move on. Just move on. Don't dwell on this chart. Don't sit here for an hour thinking, is this a breakout? Is this not a breakout? Do I consider this? What do I do with this? Is it going to buy? Is it going to sell? If it's not obvious, move on. Move on to the next chart. It's fine. There's so many charts for you to look at. Okay, so I've got a request on AUXUSD. I think you mean AUDUSD, right? Sorry, I think you mean AUDUSD, but I type AUX anyways. Let's start from a higher time frame to see if we can catch anything. The only thing I see right now is a recent breakout of this resistance, right? There was a pullback resistance here, a very nice pullback resistance as well. If I do say so myself, it is a very nice pullback resistance. So price has recently broke out here, okay? So whenever I see a breakout, what I ideally want to do is play the pullback. Okay, I usually not play the pullback. I don't want to play the short. I want to play the long from the pullback. Okay, so ideally what I want to do as a trader, when I see this, usually what I want to do is wait for price to come back down to retest or pull back to the support. And then I can consider for a buy from here, okay? Right now, price is still doing whatever it wants to do. So I'm just going to leave that. I'm not going to try to like test the market or like go against the market or test the trend. I'm just going to do what I know best, which is to wait for price to come back. And then I can enter here for a buy and then shoot up. Okay, so but this is what it's saying on the daily chart. Let's go down to the 4 hours charts to see if it's saying anything else. Nothing much on the 4 hours as well. It's saying basically the same thing that it just did a breakout, right? That's exactly what it's saying. It's basically saying that, okay, I'm out of here. The boat has sailed. You guys are on your own. Right? So ideally, I want to wait for price to come back, retest this area. This area, okay, not just this red line, not just this red support, but this area. And then I want to kind of look for an entry for a buy from there. Okay. That also means that it's not going to be today, but that is the thing about trading. It's not always right now. Okay. For those who are sometimes maybe a little impatient, I want to show you guys this quote. Trading is. I want to show you guys this quote. Maybe you guys can save it, right? You guys can save it, put it in your wallpaper, whatever it is, so that you guys can remember that trading is 10% buying, 10% selling, and 80% of the time is just waiting, right? You're just waiting for that really good entry. So right now, we're not gonna rush this. Obviously, AUDUSD just did a breakout. I wouldn't be able to find entry unless it comes back and retest. So we're totally gonna skip this because this is not something in the very near future. We want to try to find something that might happen today. Okay, so let's look at CAD/CHF. Okay, let's look at CAD/CHF. Hopefully, we can find something that might play out today. The AUD/USD looks like it might happen in the next few days, but not today. Okay, not the best looking charts. Okay, let's start with the daily first. Right away, I see a lot of like key levels here. I see a lot of resistance here in this area. I'm gonna say that this is a resistant area. So I'm gonna take this, I'm gonna pull it down to like the next, like just that wick. Okay, so I'm gonna say this is a resistant area. Why I highlighted this area? Because I wanted this area to kind of touch, touch this wick as well, touch this wick here as well, so that I can say that this is a swing high area. Okay, so on the daily, price came up, rejected this area, and came back down. Is it gonna come back down and come back up again, or is it gonna go down? We're not sure. That's our job. Our job is to find out. Okay, another resistant area that I see would be the body. Okay, the body would be another resistant area. I see the body. I see a lot of wicking here, right? There's a lot of wicking, but there's no like very odd looking body. So I'm just gonna highlight this area. Let's just pull it back. Okay, that's another area. Let's look for a trend. I don't see a very obvious trend. There might be a channel forming. Not the best looking channel, right? It is not the best looking channel, but I would say it's something. It is not the best, but I will still use it as a guiding principle to where I think price is going. So once I drew this channel, my bias now is that price is gonna move within this channel, right? It's gonna continue to move within this channel. It's gonna move within this channel, but I don't think it's gonna break this area. Okay, so your job as a trader is basically just to narrow down where you think price is going, so that you can catch those movements that you have narrowed it down to be. Okay, we've got our resistance. Let's look for a support. This is a very nice support, I would say, because this is a pullback support. There was a swing high here, price broke it and pulled back straight to that swing high area. Okay, so that is a significant area of support. Now that we've kind of narrowed down where we think price is going to go in the near future, Let's move down to the 4 hours so that we can try to find an entry. Okay, let's try to find an entry. Let's get rid of this so the screen is bigger. Right. Okay, my bias right now is that price gonna move within the channel and within the support and resistance. Okay, right now that's the bias. What we need to do now is kind of back up that bias with other things. The other thing is, now that I see another resistance, the smaller the time frame you go, the more resistance you will see along the way. Okay, I see another resistance here, so there's a possibility price might just reverse from here. Okay, if price reverses from here, that means you can enter here for a sell, right? That means you can enter here for a sell back to that support. Okay, so right now there's a significant level of resistance. The question is whether we should enter here for a sell back to the support. We can, but we need things to back us up. So it's okay to have whatever bias you want to have. You can say that, oh, CAD CHF is gonna shoot up to the moon. It's gonna make this. It's gonna do whatever. It's gonna dip down to wherever, to the lowest price it's ever gone. It's gonna go as high as it has ever gone. Whatever it is your bias is, you can have whatever bias you want, but you need to back it up with evidence, right? I can say whatever I want to say, but if indicators, if Fibonacci levels, if the indicators, if nothing, if the trend line, if the horizontal levels don't agree with what I'm saying, then that trade is most likely not going to play out. Okay, so right now I have a bias that price is going to move from this resistance back to this support. Okay, that is my bias right now. I need to back it up with tools. I need to back it up so that it becomes probable. I can rate how probable my bias is going to be. So let's get a Fibonacci retracement. There should be a 50% there. Okay, if not, it's a 90%, 61.5. It depends on which swing high we take. We should take the highest swing high. Okay, I'm going to leave the 50% there. Okay, so right now there's kind of like a 50%. Let's just maybe leave the 61 as well so that we can say it's a zone. Okay, that would be a really big zone, but yeah. So my bias right now is that price might reverse from this zone back to the support. I think it's from the 50 or the 61.8% area. It's basically from this area. That means my entry is from one of this area. It can even be now. It might even be now. Okay, that's a bias. Let's back it up with indicators. Okay, we've got a problem. So how I like to use the Ichimoku is that when price has just broken the cloud, as we can see here, when it breaks the cloud and you see the conversion line above the baseline, the conversion line is this blue line here above this red line. It usually goes in that direction. Okay. So in this example, you can see price is below the cloud as well, which is signifying that it's on a bearish, it has some bearish momentum, right? But at the same time, you can see the conversion line crossing the baseline to the upward side, right? So it's conflicting information. We have conflicting information here. I would much prefer if this blue line is below the red, and then it's just a double confirmation for me. But right now it's conflicting information. So that's the only thing we need to take note of. That's how you weigh how probable your trade is going to be, right? When you pull out the indicators, when you pull out your Fibonacci levels, you pull out like whatever it is you're using to back up your bias, and then all those things that you're using, all the tools that you're using to back up your bias is saying otherwise from your bias, that's when your probability of winning the trade has decreased, right? And that's where you decide, oh, okay, this trade, the chances of winning this trade is not as high as what I thought it would be. So that's why I should go a smaller lot size. I should go like 1% or 0.5% or whatever it is. Okay, so I would much prefer if the blue line is below the red, but it's not. So that's one thing you need to take note of. Let's look at the stochastics. Stochastics is at an overbought area, which is a good thing, right? Nope. I would much prefer if stochastics was right here. Okay. After I adjusted the settings to 21, 5, and 3, which is the settings we usually use, okay, it shows that it's not really at the oversold area. The more oversold area is at this zone right here, right? This zone right here is where the overbought area is. Sorry, yeah, the overbought. So let's say this indicator is showing that price is here, then I would be even more confident because it would signify to me or indicate to me that okay, price is at a very overbought area. It's time for it to reverse, right? But right now it's not. On top of that, Ichimoku is giving conflicting information. Okay, it's giving conflicting information. Let's see what RSI is saying. RSI is not saying much. It's not saying much. Yeah, it's not saying much, to be honest. Okay, so after analyzing using whatever indicators I usually use, I realized that maybe price would be a short, but this would probably be not the best entry. Maybe now is not the best entry. Okay, we might want to wait until stochastics get here. You might want to wait for Ichimoku to give you a better sign to get in. But if you really do want to take this trade on a graphical level, this trade looks like it's gonna make a short, but the indicators are saying otherwise. So if I have to rate this trade and how probable I think it was, I would say it's like a 60%. If you still want to take a 60% trade, a chance of winning kind of trade, you can, but like go a really, really small lot size, right? Never take a trade where you feel like it's less than like 60%. 60% is a minimal, like the most minimal you should go when deciding if you should enter a trade. Let's say you find a setup and you're like, oh, I only feel like there's a 40% chance of winning. If there's a 40% chance of winning, don't even bother getting in, because there's a higher chance of you losing this trade. But for this, I feel like there's a chance that price might go down, but my confidence level is like, I would say my bias is, I have a weak bias that price is going to drop from here. Okay. So yeah, that's how we look for setups, and that's how we analyze charts here. And once you do that, you kind of weigh what trades you want to take and what trades you don't want to take, and that will actually increase your probability of winning and your probability of growing your account. Okay, so that's all the time I have for you guys today. Thanks for attending our webinar. Please like and share our webinar so that we can continue to do these webinars for you. I'll see you guys again on Thursday. The next class is on Thursday. Sorry, the next webinar is on Thursday. We're going to be doing live analysis on that webinar. So live analysis is basically, well, our main focus is just to look for setups, right? It's strategy clinic. It's kind of how we use what strategy we use to look for setups. And that is, I would have to say that is more of an advanced class, because when we are looking for setups, you would kind of need to already know why I'm using the Fibonacci level, right? Why I'm using certain things, why I'm using certain tools, why I'm using certain indicators, right? So you would need to have some basics to be able to follow the class on Thursday, right? But if you are new here, if you are a beginner, I do recommend that you just continue to follow the Tuesdays and Mondays ones. The Mondays is basically going through fundamentals, and Tuesdays, which is today, we're going through the basics. Like today we did trade and risk management, which is kind of like the foundation or the fundamentals of technical analysis, right? Thanks, you got this. Thank you, Martha. And Thursdays are a bit more advanced, so do join the Thursdays one, whether if you're a beginner or not, just to have a feel of it. Okay, so I'll see you guys on Thursday. We'll look for more setups then. Thank you, Simon. We've got, thank you. I think it's the same time. It's gonna be 5 p.m. Singapore time. Okay. I don't know where you guys are from because I didn't get to talk to you guys in the beginning. That's the introduction. But 5 p.m. Singapore time. Okay, 5 p.m. Singapore time is 10 a.m. in the United Kingdom. Okay, so I'll see you guys on Thursday, 5 p.m. Singapore time. Just check the time before you guys join. I think this is always the same time. It is always the same time, but if I'm not mistaken, in Europe, you guys have like daylight saving now. So you guys have like daylight saving. So 5 p.m. for you guys would be like 1 hour later, I think, or the same time for you guys. Then 5 p.m. would be different for the Singaporeans. Just take note that it's 5 p.m. Singapore time. Okay. And I'll see you guys on Thursday. Okay. Bye, guys. Thanks for attending. Please like and share. Remember to like and share. See you guys. Thank you, Jose. Thank you so much.